Thanks for tuning into this conversation. I'm your host, Neeraj Shah. The equity markets, notwithstanding, the commodity markets are certainly seeing some signs of action. China's August industrial output last week was about 4.5% versus expected 3.9. Retail sales were looking okay. And we're seeing, maybe because of that or otherwise, the impact being seen on some of the commodity prices as well. Thermal coal prices are up over 15, 16% in the last few in a limited time frame. Pet coke prices are up as well. So the question that comes to mind is: are things starting to change when it comes to commodities because of the China impact or otherwise? And what's the impact of that likely gonna be on specific pockets related to commodities? Rakesh Arora, Go India Advisors, joins in with his thoughts on the same. Rakesh, great having you. Thanks for taking the time out.
Yes.
Have any of the moves that have happened in the base commodities in the recent past come as a surprise to you?
So, Neeraj, there is a lot of expectation that China would come out with a bigger stimulus, given the state of economy. Though it's slightly, not very clear because till now what they have done is only piecemeal changes. They have cut interest rates, which doesn't really move the needle. They really need to come out with fiscal incentives or fiscal stimulus, I would say, rather than a monetary policy, which has been missing till now. So it's not extremely clear which way we are heading in terms of the strength of the stimulus. But having said that, there is a big buoyancy because there's a lot of investment happening into the new energy, or the renewable system, and that is actually really supporting the demand quite strongly in China. So despite the housing slowdown, government has been investing heavily on infrastructure. And just to quote you, a little bit of numbers. In the first half, China has added around 100 gigawatt of solar and wind capacity. Now take a guess how much is the total capacity of say US, which has been doing it for so many years. It's only around 228 gigawatt. So in first half they're done like, maybe this year they might surpass what US have. So that is the kind of investment which is happening and which is keeping commodities demand reasonably buoyant, despite the housing sector not doing so well. And it's unlikely that housing sector would start to do well immediately because this is a question of trust and confidence, which takes slightly longer to build in. Just a mere few percentage point cut in interest rate is not going to bring that kind of trust back.
Point well taken. Assuming that we can't quite pencil in when is it that China will give a big bang stimulus, or whether they even give it in the first place, right? Because President Xi Jinping probably does not want something like that. So, in light of that, we've still seen an uptick from the lows in the prices of some of the base commodities as well. Rakesh, what is your own sense of where does this up move lead to, keeping in mind the current situation as is without factoring in any kind of Chinese stimulus?
So, see, if you think like 6 months or 1 year forward, basically, if you look at rest of the world, maybe we are peaking in terms of our interest rate hike cycle. So things are going to improve a little bit from there. Secondly, China, as we are saying, there is a stimulus. How big it is? So there's a slightly positive buoyancy on the demand side, and which is what is getting reflected into metal stocks and commodity prices. But will it be the big cycles that we have seen in 2008 or even the COVID post-COVID cycle that we saw? I don't think it's going to match that. There's a little bit of buoyancy, but it's not going to be a bull cycle in the near term. As we look at the demand supply for most of the commodities, everything is in a little bit surplus. Even copper or aluminum, for that matter, which are more in demand as compared to steel. Everything is in surplus for at least this year and maybe early next year, given the current projections for demand and supply. So I'm not really expecting a big bang up move, but yeah, there is a little bit of positive sentiment.
What does it do for end user industries, cement, for example, or some others?
So, Neeraj, the big question into the second half of this year is, what China does in terms of climate control and, environment. Historically, they have cut production in October to December period. because smog really takes over in some of the Chinese cities, and they cut steel production, etc. Now, at the moment, there are no indications of that, and given the way economic cycle is, I'm not sure also they can dilute this. Now, if they do production cuts, it's positive for steel and negative for iron ore and coking coal and even thermal coal to some extent. If they don't do it, reverse is true. So it's kind of a catch 22 situation. At the moment, the bulls on steel and coal both have their own viewpoints, but which one it will turn out, it's difficult to say. So I really go by that is that it's neither as good or bad as it looks. So I would say we are into a moderately positive environment.
Got it. The steel bulls also talk about the India infrastructure and the point about how some of the larger companies are going to up the volumes in the next 12 to 24 months. Are you constructive on Indian ferrous?
Yeah, so August was the first month where we saw a strong demand come back for steel, and this actually is because of monsoon weakened quite significantly in a lot of the part of the country, and so demand actually came back much earlier than normally you see in a monsoon season. And also we are into a pre-election year, so government is in a big rush to complete the projects. Not just for steel but also cement, we are seeing double-digit demand growth currently, and that's why you see some uptick in long steel prices, which are outperforming the flat steel because flat steel is more driven by export demand, etc. So yes, this buoyancy is going to remain for some time. But see, India is not the price setter for global commodities. If they are price taker, only marginal physical premium might change here and there. So yes, we are bullish on the demand outlook for India, but it's only marginally positive. I think there's a big rotation happening in the market, and because retail investors are so active, they're looking for cheaper value stocks. And when you look at metal, they relatively look cheaper. So there's a big rush, and something which we would have discounted like 2 years later, people are starting to discount now. So that kind of trade is happening.
I take it you are not very constructive.
So I would say that at current valuation, it doesn't really leave too much. Meaning already it is factoring in, a mid-cycle kind of earning, which is what is the scenario right now. And I'm not really expecting a bull cycle for it to really go to that upper band. So I would say that okay, there are trading gains to be made here, probably because of the sentiment and rotation into value stocks per se. But is it a start of a new bull cycle? It doesn't appear to be so.
All right. You were constructive on cement. Maybe you still are. Do these rising input cost prices temper that optimism for the very short term a little bit? Maybe the long term is still good, but the very short term, tactical 3 6 months, does it temper the optimism?
So I wouldn't think so much into it. The energy costs are probably inching up a little bit, but they've come off a long way from the peak which they were in, early 2022. So there's still decent room for these companies to good have a good margin expansion. And secondly, demand, as I was saying, is running in double digits. So the only factor which is not really playing out properly is Ultratech trying to push more volume and not really worry too much about pricing and margin. But I think we are into a favorable season now where normally price hikes happen. So I would tend to think that, and price hikes are normally bigger in component as compared to the cost increases. So I won't really worry too much. Normally, a little bit of cost push is good because it pushes the industry to take the price hikes, and so cement is in a sweet spot right now.
Okay. And remember, viewers, this is the tactical term. For the slightly longer term, there's a conversation that we've done with Rakesh some time back. You might want to actually get a sense of that as well. Rakesh, one final question, if you will. The next 12-month view, if indeed, even if there is no hard landing, but there is a soft landing, but which means that there is a bit of a pullback in the US end and maybe European end as well. Does that actually augur well for Indian commodity manufacturers like cement, simply because that would mean that the overall cost pressures of the input costs might actually cool off in the next 12 months compared to where they are right now?
Yes, so see, for cement, unless it is a very sharp increase in cost, it really doesn't matter because it's a domestic commodity and they are able to pass it on. Because Ultratech would like to, the leaders would like to, keep margins at certain level. So that's the minimum. So that's why, cement is a low risk and that's why it gets a high multiple. I think so. Cement is probably decent for the next few months till the time election. Post election, there would be a little bit of lull in demand, which I am expecting. So people have to time a little bit their trade. But for the next 6-8 months, it looks okay.
Great. Rakesh, so good talking to you. Thank you so much for giving us a lowdown. Really appreciate your time.
Thank you so much.
Thank you. And viewers, thanks for tuning into this conversation.